Hello everybody, this is Ehab. Today we're going to talk about the difference between mutual funds, index funds, and ETFs. Investing is one of the most important things in your life. And in order to understand investing, you have to understand the language of investing. Now, if you watch CNBC or any other business channel, or even if you read articles online regarding business or any other financial information, you'll see and hear the terms ETFs, mutual funds, and index funds being thrown around. But what are they? What do they mean, and how is each one is different from the other? And most importantly, which one you want to be invested in. So let's start by defining what each one of them mean and dig deeper from there. The first one is mutual funds. A mutual fund is basically a company that pulls the money from multiple investors and invest their money into a group of stocks and bonds. Those investors would buy shares into those mutual funds. And each share that you buy is basically an interest in ownership and the income that it generates from that fund. So in short, by owning a mutual fund, you're owning multiple shares of stocks, but you're buying one class of assets. Now that step gets you instant diversification. You don't have to wait to get multiple stocks and pick and choose individual stocks on your own. The minute you buy one share into a mutual fund, you're immediately invested into multiple shares. And by having a diversified portfolio, you're basically reducing your risk because you're investing into multiple shares of stocks instead of buying one single share of stock. Now, the other part about mutual funds is that they are actively managed. And what that means basically is that there's somebody that is managing these mutual funds. And when you have somebody managing these funds, you're automatically going to assume that there are fees associated with it. So mutual funds are just like stocks. You can find them actually on any brokerage firm. You can just buy into them yourself. You don't need to have, a broker to get you into buying into a mutual fund. An example of a mutual fund is Vanguard's Life Strategy Growth Fund, ticker symbol VAXGX. Now, this mutual fund has a minimum investment of $3,000 and has an expense ratio of 0.14%, which is quite high compared to other index funds and ETFs. So basically, you're going to be paying $14 for every $10,000 you're investing. The average return on this specific Vanguard's mutual fund is 8.5% since inception, which is of course lower than the S&P 500. Now let's talk about index funds. Index fund is also a type of a mutual fund. However, an index fund follows a specific index, such as the S&P 500. An index fund must follow a fixed formula. That's why that eliminates the need to have someone to professionally manage those index funds. And by not having a professional management to manage those index funds, you're eliminating a lot of the fees that comes with it. Now, there are still fees that you have to pay when you invest into an index fund, but they're so little that you're not even going to pay attention to them. Now, one thing just to remember is that all index funds are mutual funds, but not all mutual funds are index funds. An example of an index fund is S&P 500 Index Fund, ticker symbol VOO. And as the name implies, this specific index fund follows the S&P 500, which is the largest 500 corporations that are included in the index. So when you purchase one share of Vanguard's S&P 500 Index Fund, you're actually purchasing into the 500 companies. You're owning portion of them that are included on the S&P 500. And again, since you're purchasing almost 500 companies all together at once, you're getting instant diversification and you're invested at a very low cost. The expense ratio for the Vanguard's S&P 500 Index Fund is 0.03%, which is basically you're paying $3 for every $10,000 invested, and that is super cheap. The average return on this index fund is almost identical to the S&P 500 since they're pretty much mirroring each other. So the average return, you're looking at 10% per year, give or take. Now the last one is ETFs. ETFs, they stand for Exchange Traded Funds. Now they're similar to a mutual fund is that the investment fund is actually traded just like an individual stock. The main difference between an ETF and a mutual fund is that you don't have to go through an actual mutual fund holder to purchase an ETF. You can pretty much buy and sell ETFs on the open market. Another difference is that mutual funds typically have a minimum investment amount, similar to the one we mentioned before where you have to have $3,000 to invest at a minimum to get into a mutual fund. ETFs don't. You can pretty much buy an ETF at the price of a one share. ETFs can also follow other industries like oil, commodities, retail, but these are more for a little bit more sophisticated investors. But for beginners, typically I would stick with an S&P 500 index fund. Now, an example of an ETF is Vanguard's Large Cap Index Fund ETF, ticker symbol is VV. So between mutual funds, index funds, and ETFs, you have a large variety of things to invest in, as long as you know the differences between the three. And of course, always keep in mind the fees associated with each one of them, as well as the returns that they're going to give you at the end of the year. So that was it for today. I hope that was helpful. This is basically the difference between mutual funds, index funds, and ETFs, and I hope that sheds some light on how you can invest into them and make some money while doing that. Thanks again for watching, and until next time.